The Dow Jones Industrial Average closed at a record high yesterday, the highest close in the history of that index, above 52,000 for the first time ever. And on that exact same day, Iran's government formally accused the United States of violating the ceasefire agreement between the two countries. Not a vague statement, not an ambiguous diplomatic signal open to interpretation, a direct accusation on the record that Washington broke the deal it claims is holding. Two facts. Same 24 hours, completely incompatible with each other, and almost nobody has put those two headlines next to each other and asked the obvious question: how can the stock market be having its best day in months on the exact day a war it's supposedly celebrating the end of just got accused of restarting? I want to walk you through what actually happened yesterday, because the sequence matters. And most coverage treated these as two separate stories running on two separate tracks, when they are in fact the same story told from two completely different rooms. In one room, the trading floor of the New York Stock Exchange, things were very simple. The Dow Jones Industrial Average rose more than 300 points to close above 52,000 for the first time in its history. The S&P 500 rose over 1%, the Nasdaq Composite gained over 2%. Alphabet, freshly added to the Dow as one of its 30 component companies, jumped nearly 5% on its debut session, helping carry the entire index to its record. Traders described the mood as confident, even celebratory. The driving narrative in that room was straightforward. The United States and Iran had agreed to halt hostilities over the weekend. Commercial shipping was being allowed back through the Strait of Hormuz. A diplomatic meeting in Doha was reportedly scheduled for this week to formalize a broader resolution. The war, in the story being told on the trading floor, was ending. In the other room, the actual geopolitical reality, a very different story was unfolding at almost the exact same hour. Iran's government issued a formal accusation that the United States had violated the ceasefire agreement. This is not a minor diplomatic complaint. An accusation of ceasefire violation is one of the most serious things one government can say about another in the context of an active conflict, because it implies that the legal and political framework holding the guns silent has already broken down, at least from one side's perspective. At nearly the same moment, Iran's foreign ministry spokesperson stated explicitly that there would be no negotiation meetings at any level with the American side in the coming days, not a postponement, not a scheduling conflict. A flat denial that any talks were happening at all, delivered by an actual government spokesperson on the record, while American officials were simultaneously telling reporters that a meeting in Doha was confirmed and that Secretary of State Rubio and Special Envoy Steve Witkoff were preparing to brief Congress on the contents of an initial peace deal. I want you to sit with the absurdity of that for a moment. Two governments, the two principal parties to an active military conflict, telling the public two entirely different stories about whether they are even talking to each other. And while that contradiction was unfolding in a separate but related move, Iran's deputy foreign minister announced that Iranian and Omani officials would begin talks on redefining transit paths through the Strait of Hormuz, and that Iran intended to obstruct any vessels that traveled outside those defined paths. Read that carefully. Iran is simultaneously saying there is no peace process happening with the United States, while announcing a unilateral framework for controlling maritime traffic through one of the most strategically vital waterways on the planet. That is not the behavior of a government in a state of confused chaos. That is the behavior of a government running two parallel tracks deliberately. Deny diplomacy publicly, for whatever domestic political purpose that denial serves, while quietly building the operational and legal architecture to control the Strait of Hormuz, regardless of whether a formal deal with Washington ever materializes. Now let's go back to the trading floor, because I think most analysis of market behavior during periods like this gets the mechanism wrong. And getting the mechanism right matters enormously for understanding why this contradiction exists at all. Markets are not actually pricing in the full, nuanced, contradictory reality of the Iran situation. Markets are pricing in a simplified narrative, and that narrative gets built primarily from a small number of salient, easily digestible signals: tanker traffic resuming through the strait, a scheduled meeting being announced by the more market-moving of the two governments, which in this case is the United States, because American officials speak in language that financial markets are specifically tuned to interpret official statements, scheduled briefings, named diplomats. Iran's denials, by contrast, often get filtered through translation, through skepticism about Iranian state messaging that Western financial media has built up over decades, and through a market structure that is fundamentally built to find reasons to be optimistic, because optimism is what generates trading volume and keeps the broader bull market narrative intact. This is not a conspiracy, Nobody on a trading desk woke up yesterday and decided to deliberately ignore Iran's ceasefire violation accusation. What happened is more mundane and, in some ways, more concerning. The market simply weighted the signals it understood and trusted more heavily: the resumed tanker traffic, the announced Doha meeting, the index inclusion mechanics around Alphabet, over the signals it found harder to parse or less credible: Iran's formal accusation and flat denial. The result is a market that is technically responding to real information, but selectively, in a way that produces a record high on a day when the underlying conflict it is supposedly pricing and just took a meaningful step toward renewed escalation. Here's where I need to introduce the historical pattern that makes this moment less unprecedented than it might feel, and more genuinely worrying once you understand the pattern's track record. Markets have a well-documented tendency to price in the end of wars well before wars actually end, and in some historical cases, well before wars even meaningfully begin to wind down. In the summer of 1914, in the weeks immediately preceding the outbreak of the First World War, European stock markets remained remarkably calm, even optimistic, with many investors and analysts confidently predicting that any conflict, should one occur, would be brief, contained, and resolved within months. That confidence was catastrophically wrong, and markets across Europe eventually had to close entirely for extended periods as the actual scale of the war became impossible to ignore or price around. The lesson from 1914 is not that markets are stupid. The lesson is that markets are built to price probability-weighted scenarios based on available information, and when the available information is itself contradictory, incomplete, or actively being managed by the parties involved, markets can produce prices that reflect a story nobody fully believes, but that nobody has strong enough information to bet against. A more recent example, one many of you will remember directly, involves the early weeks of Russia's invasion of Ukraine in 2022. In the days immediately following the invasion, global equity markets experienced significant volatility, but within a relatively short window, a pattern emerged where markets began pricing in scenarios of rapid resolution, swift Ukrainian collapse, or swift negotiated settlement, neither of which materialized for years. The market's initial pricing reflected the dominant narrative being told by analysts and officials in the first days of the conflict, a narrative that turned out to be substantially wrong about both the duration and the trajectory of the war. Markets adjusted, eventually, but the adjustment lagged the reality on the ground by a meaningful margin, and investors who positioned based on the early optimistic pricing absorbed real losses when reality caught up. I raise these historical parallels not because I believe the current Iran situation will necessarily follow the same trajectory as either 1914 or 2022. Every conflict has its own specific dynamics, and there are genuine reasons to believe a ceasefire framework, however fragile, gives the situation more structural stability than either of those historical examples had. But the underlying mechanism, markets pricing and resolution based on incomplete or contradictory information, asymmetrically weighting optimistic signals over pessimistic ones, is a pattern that has repeated across multiple conflicts and multiple historical eras, and recognizing the pattern matters precisely because it tends to repeat, regardless of the specific details of any individual conflict. Now, let me give you the honest counter-argument, because if I only present the version of this story that confirms my framework, I am doing advocacy, not analysis. The Steelman case for the market's behavior goes like this. Markets are forward-looking by design, and forward-looking pricing inherently involves discounting near-term noise in favor of medium-term trajectory. A single accusation of ceasefire violation, however serious it sounds in isolation, may simply be diplomatic theater, posturing intended for domestic political consumption in Iran rather than a genuine signal that the underlying de-escalation process has broken down. Iran's foreign ministry spokesperson denying scheduled talks while other Iranian officials simultaneously discuss redefining Hormuz transit paths with Oman could reflect normal bureaucratic friction within the Iranian government rather than a deliberate two-track strategy. Governments, especially governments under the kind of internal political pressure Iran is currently navigating, frequently send mixed signals not because of strategic calculation, but because different factions within the government are genuinely saying different things, with no single coordinated message being deliberately managed. Furthermore, markets have actual structural reasons to be optimistic about this specific situation that go beyond simply ignoring bad news. Shipping data shows that tanker traffic through the Strait of Hormuz reached its highest level since the conflict began at the end of February just last week. That is real, measurable, physical evidence of de-escalation, not just rhetoric. Real ships carrying real cargo are actually transiting a waterway that was effectively closed to normal commercial activity for months. That is not a market hallucinating peace. That is a market responding to verified operational data showing the practical effects of a ceasefire, even an imperfect one, are real. That argument is serious and I don't dismiss it. But here is where it breaks down for me, and where the gap between the trading floor narrative and the geopolitical reality becomes too wide to explain away as simple, forward-looking optimism. The tanker traffic increase, while real, remains, according to the same shipping data, far below pre-conflict levels. The market is treating a partial, fragile recovery in shipping as confirmation of full normalization, when the actual data shows something much more modest and much more reversible. And the ceasefire violation accusation is not coming from an anonymous source or a low-level official engaging in domestic political theater. It is coming from Iran's government formally on the same day Iran's foreign ministry spokesperson is denying the existence of talks that American officials are simultaneously confirming to Congress. When the denial and the accusation come from the same government on the same day, dismissing both as mere noise requires ignoring that this government has, in this specific conflict, repeatedly demonstrated a willingness to escalate rhetorically and operationally when it calculates that escalation serves its negotiating position. The pattern of behavior here is not random mixed signaling. It looks structurally like a government using denial and accusation as deliberate negotiating tools, applying pressure on multiple fronts simultaneously while quietly building leverage over the Strait of Hormuz, regardless of how the formal diplomatic track resolves. Let me walk you through what I believe is actually happening underneath both headlines, because I think the framework here is more useful than simply declaring the market wrong or Iran's accusation overblown. I believe Iran is running what amounts to a two-track strategy, and recognizing both tracks simultaneously is the only way to actually understand yesterday's contradiction rather than just observing it. Track one is the public diplomatic track, the track where Iran denies meetings, accuses the United States of ceasefire violations, and maintains a posture of defiance for domestic political consumption and for leverage purposes in whatever negotiation actually is happening behind closed doors, regardless of what gets publicly confirmed or denied. Track two is the operational track, the track where Iran is quietly establishing unilateral rules over Strait of Hormuz transit paths, building a framework of control that exists independently of whatever happens with Washington diplomatically. Track two does not require a peace deal to succeed. Track two succeeds simply by Iran establishing de facto control over how ships move through one of the most economically vital waterways in the world, with or without American sign-off, with or without a formal ceasefire holding. If that framework is correct, then the market's record high yesterday is in a strange way celebrating the wrong track. Markets are pricing in resolution of track one, the diplomatic track, the Doha meeting, the formal ceasefire. But the more strategically significant development yesterday may actually have been on track two, Iran's quiet move to redefine and control Hormuz transit paths unilaterally. That development barely registered in market commentary, buried under the more dramatic, more easily narrated story of a denied meeting and a ceasefire violation accusation. And that is precisely the problem with markets pricing in simplified narratives. The thing that actually matters most strategically is often not the thing generating the most dramatic headline. There's a layer underneath the index mechanics themselves that almost no one explains clearly, and it matters here because it shows how much of yesterday's record high had nothing to do with Iran at all, which makes the contradiction even starker once you see it. Alphabet's inclusion in the Dow Jones Industrial Average is not simply a story about investors deciding Google's parent company looks attractive. It is a mechanical event. When a major index adds a new component, every fund built to track that index, every passive retirement vehicle, every algorithmic strategy benchmarked against the Dow is required to buy shares of that new component regardless of what any individual investor believes about the geopolitical backdrop. Billions of dollars in mechanical, non-discretionary buying flowed into Alphabet yesterday purely because of an index reshuffling decision made weeks earlier, a decision that had been scheduled and announced well before this particular round of Iran tensions even began. Layer on top of that the separate news that Comcast shares surged over 20% after announcing plans to split into two separate publicly traded companies, a corporate restructuring story with zero connection to the Middle East. When you start pulling apart yesterday's record high and asking which dollars were actually expressing a view on Iran versus which dollars were moving for reasons entirely unrelated to geopolitics, a meaningful portion of that record close starts to look less like a confident bet on peace and more like an accounting coincidence that happened to land on the same calendar day as a ceasefire violation accusation. That doesn't mean none of the rally reflects real optimism about de-escalation. It means the headline number, 52,000, a record close, is doing more narrative work than the underlying mechanics actually support, and that gap between narrative and mechanics is exactly the kind of thing that gets lost when a single chart gets held up as proof that the market has rendered its verdict on the war. There is also a domestic Iranian political dimension to this story that deserves more attention than it has gotten, because it complicates the simple picture of Iran as a unified actor running a deliberate two-track strategy. Iran's own parliament has publicly rejected claims by the Trump administration that the country's unfrozen assets, the billions of dollars being released as part of the broader Memorandum of Understanding, will be used specifically to purchase American agricultural products. American officials have maintained publicly and repeatedly that any released funds remain subject to American approval and oversight, with a senior official explicitly stating that if Iranian assets are released, they will be used to purchase American agricultural products to feed the Iranian people. Iran's parliament is on the record disputing that characterization. This is not a disagreement between Iran and the United States. This is a disagreement happening inside Iran's own government, between its executive branch, which appears to be engaging with the broader framework of the Memorandum of Understanding, and its legislative branch, which is publicly pushing back on specific terms of that same framework. When a government's own parliament is contesting the terms its negotiators have reportedly agreed to, that tells you something important about how fragile the underlying political coalition supporting any deal actually is inside Iran. A ceasefire that requires sustained domestic political buy-in across multiple factions of Iran's government is structurally more fragile than a ceasefire that simply requires one negotiating team to hold its position. And right now, the negotiating team and the parliament do not appear to be telling the same story about what was actually agreed to. This fragility matters enormously for anyone trying to assess who actually benefits and who actually loses as the situation continues to unfold, because the winners and losers here are not simply the United States and Iran. Qatar and Oman, the two nations serving as primary mediators in this entire process, are accumulating a kind of diplomatic capital that persists regardless of how the underlying conflict resolves. Every round of shuttle diplomacy, every hosted meeting, whether or not it actually happens as scheduled, reinforces both countries' positions as indispensable intermediaries in a conflict the rest of the world badly wants resolved. That is a durable strategic asset that doesn't evaporate even if Doha collapses this week. Defense contractors occupy a similarly durable position, benefiting from continued uncertainty in the form of sustained military spending commitments, while also benefiting from any actual peace dividend in the form of broader market optimism, lifting their share prices alongside everything else. The clearest losers in this specific picture are retail investors and ordinary savers whose retirement accounts are passively riding index funds into a rally substantially built on mechanical index inclusion effects and corporate restructuring news that has nothing to do with the underlying war, dollars that will not protect those accounts if the actual diplomatic and military situation deteriorates in the way Iran's ceasefire violation accusation suggests it might. There is one more risk worth naming directly before we close, because it's the scenario that would make today's contradiction look quaint in hindsight. The most dangerous version of this story is not that markets are wrong about the pace of de-escalation. The most dangerous version is that markets are pricing in such confident optimism that a single incident, one tanker hit, one drone shot down, one miscalculated strike near the strait could trigger a reversal far more violent than the slow, steady climb that produced yesterday's record high in the first place. Rallies built on fragile, contested narratives tend to unwind faster than they build, because the same passive buying that mechanically lifted prices on the way up provides no similar mechanical support on the way down. If Doha collapses publicly this week, if Iran's parliament forces a renegotiation of terms already reported to Congress as settled, or if a single violent incident in the Strait makes the ceasefire violation accusation impossible to wave away as rhetoric, the unwind would not be gradual. It would be the kind of single-session move that erases months of gains and hours, precisely because so much of the rally was built on a story rather than on verified, stable, underlying fact. Here is what I want you to watch in the coming days, because the next week will likely tell us a great deal about which track is actually driving outcomes. Watch whether the Doha meeting Trump announced and Iran denied actually happens, and if it does, watch closely what specific terms come out of it regarding the Strait of Hormuz. if the meeting produces an agreement that incorporates or acknowledges Iran's proposed transit path framework, that tells you Iran successfully used denial and pressure tactics to extract concrete operational control while still getting credit publicly for participating in good faith diplomacy. Watch tanker traffic data over the coming weeks specifically, not the headline percentage increases that get reported, but the actual volume relative to pre-conflict baselines. The gap between reported optimism and actual normalized shipping levels is the single clearest indicator of whether the market's pricing reflects reality or reflects a story the market wants to believe. And watch whether Iran's parliament, which has already publicly rejected elements of the Memorandum of Understanding regarding how frozen assets get used, creates further domestic friction that undermines whatever Iran's executive branch is negotiating, because a fractured Iranian domestic political position adds another layer of uncertainty that no market pricing model fully captures. I could be wrong about how deliberately coordinated Iran's two-track strategy actually is. It's entirely possible that what looks like deliberate strategic sequencing is actually just the visible mess of competing factions within Iran's government pulling in different directions without any unified plan. I could also be wrong about how significant the gap between market pricing and ground truth actually is, given that markets have, on balance, been broadly correct that this conflict has de-escalated meaningfully since its most intense phase in late February. But I don't think I'm wrong about the core observation that started this entire analysis. A record stock market close and a formal ceasefire violation accusation happened on the same day, and almost nobody treated those two facts as belonging to the same story. That gap between what gets celebrated on a trading floor and what gets formally accused in a foreign ministry statement is worth sitting with longer than a single news cycle typically allows. So here's the question I actually want you to think about, and I want you to think about it honestly rather than just picking the answer that confirms what you already believed walking into this video. If markets are right and this genuinely is the beginning of real durable de-escalation, then Iran's ceasefire violation accusation and its quiet Hormuz transit framework are just noise on the way to a real deal. And you should feel comfortable that the optimism reflected in that record high is justified. But if Iran is right and the ceasefire has genuinely already been violated in a way that matters, then that record high was built on a story that isn't true. And the correction, whenever it comes, won't be gentle. I don't think there's a clean way to know which version is correct from where we're standing right now. I think the honest answer is that we are all, markets included, making a bet on incomplete information, and the only thing I'm confident about is that the bet being made on the trading floor yesterday was a much simpler, much more optimistic story than the one Iran's own government was telling about itself on the exact same day.